Hello guys, welcome to my YouTube channel. Today we will talk about crypto banking and decentralized finance. The context of the situation is as follows. Since cryptocurrencies gained popularity in India as a result of sudden rise in Bitcoin prices, the RBI has repeatedly reiterated its strong opposition to them. According to the central bank, cryptocurrencies pose serious threats to the country's macroeconomic and financial stability. In a little more than a decade, the development of Bitcoin and thousands of other cryptocurrencies has changed the definition of money. They spawned a parallel universe of alternative financial services, allowing crypto business to move into traditional banking territory. Recently, new services and platforms have been introduced to assist people in managing Bitcoin and other digital coins in their day-to-day finances. Let us delve deeper into the subject. First, rise of cryptocurrencies. Following the success and popularity of Bitcoin, many newer coins have been introduced with a total market value of 2.5 trillion by May 2021. Second, the importance of cryptocurrencies. Corruption prevention. Because blocks operate on a peer-to-peer network, they aid in the prevention of corruption by tracking the flow of funds and transactions. Second, time effective. Because it is conducted entirely on the internet, has very low transaction fees and is almost instantaneous. Cryptocurrencies can help save money and significant time. Cost effective. Intermediaries such as banks, credit card companies, and payment gateways take nearly 3% of the total global economic output of more than 100 trillion as fees for their services. Integrating blockchain into these industries could save hundreds of billions of dollars. Now let's talk about India's cryptocurrencies. First, RBI's concern. The RBI issued a circular in 2018 prohibiting all banks from dealing in cryptocurrencies. In May 2020, the Supreme Court ruled that this circular was unconstitutional. The government's position. The government recently announced that it will introduce the Cryptocurrency and Regulation of Official Digital Currency Bill 2021 to create a sovereign digital currency, increasing the ecosystem of startups. The fund invested in India's blockchain startup account for less than 0.2% of the total amount raised by sector globally. The current cryptocurrency approach makes it nearly impossible for blockchain entrepreneurs and investors to gain significant economic benefit. Now let's see what services crypto business provide. Services for lending and borrowing. In general, crypto companies provide lending and borrowing services. Interested can earn on digital currency holdings, which is often much higher than interest earned on cash deposits in a bank. Bank collateral. Borrowing using cryptocurrency as collateral to secure a loan because transactions are backed by digital assets. Most crypto loans do not require a credit check. Benefits. Encourages financial inclusion. Consumers can expect an unusually high return on their investments. Customers in countries with volatile government-issued countries will benefit from financial stability. What exactly is cryptocurrency banking? The virtual currency is not physically held. Digital currency is decentralized thanks to the blockchain ledger system, which means it is not controlled by a bank or central authority. Cryptocurrency banking primarily allows people to store their funds in a digital wallet or spend them in the same way that they would traditional money. Exchange platforms allow users to manage their cryptocurrency balances. These banking services can include simply maintaining a balance, making payments with a crypto debit card, and even earning interest using one or more cryptocurrencies. Now let us talk about why are the yields so high. Similar to traditional banking, cryptocurrencies like traditional banks pool deposits to make loans and pay interest to deposits. There are no reserve requirements. However, banks are required by law to maintain minimum reserves as a safety net. Crypto banks, on the other hand, do not have reserve requirements, and the institutions to which they lend can make risky bets. Other risks include cyber attacks, extreme market conditions, or other operational or technical issues that could result in a temporary or permanent halt to withdrawal or transfers. What exactly is a stablecoin? Cryptocurrency is extremely volatile, making it unsuitable for transactions such as payments or loans. This is where stablecoins came to play. Stablecoins are cryptocurrencies that are pegged to stable assets, most commonly the dollar. They are intended to provide the consistent value of government-issued currency in digital form for blockchain transactions, but they are issued by private entities. Tethered and USD coin are two popular dollar-linked tokens, globally appealing. The total value of stablecoins in circulation has increased from 29 billion in January to 117 billion as of early September. Maintain the high value of digital currency. It aims to do what government money does in digital form. However, private entities issued, they offer the consistent value of government issued money in digital form for blockchain transactions, but they are issued by private entities. There are risks involved. Stablecoin users manage supply and demand in the same way the central bankers do. However, there is no guarantee that they have the one-to-one dollar backing they claim. As a result, a sudden increase in withdrawals could risk one of those assets to collapse, putting clients and the broader economy at risk. Furthermore, a central bank digital currency would render a stablecoin obsolete. What is the digital currency of a central bank? Provide dependently. Central banks are investigating the possibility of issuing a government-issued cryptocurrency, which would combine the convenience of crypto with the dependability of money controlled by a central bank. Growing innovation is a challenge, but governments catching up to the market innovations will take years. Introducing India's own cryptocurrency, the government is considering launching India's own cryptocurrency named Lakshmi. Now let us talk about the requirements. Cryptocurrency is a type of digital currency that allows transaction parties to remain anonymous while confirming the transaction's validity. The anonymity provision is widely abused, particularly in cross-border transactions. They are commonly used for money laundering, terrorist funding, drug trafficking, and other illegal activities. The growing share and presence of bitcoins as a result of speculative trading for return on investment is becoming a source of concern. What role can legislation play in addressing this? Fiat currency status. India's attempt to legalize its own cryptocurrency would give it fiat currency status. This formal government approval may prove to be a viable alternative to popular non-fiat cryptocurrencies such as Bitcoin and Ethereum. Keeping up with times, Lakshmi would use a variant of the blockchain technology used by Bitcoin. Avoid dual transactions. The technology would aid in verification of every trade and eliminate the possibility of dual transactions using the same coin. In terms of cross-border transactions, the new currency would be subject to the same capital account controls as the rupee. Money cannot simply be manipulated. Unlike traditional fiat currencies, the money supply at any given time is known and cannot be manipulated. Furthermore, users would be subject to the standard Know Your Customer requirements. Now let's talk about the difficulties. With the introduction of new cryptocurrency, it would become legal tender alongside the rupee. This necessitates legislative action in the form of amendments to the Currency Act. Pegging it to the rupee would have an effect on the rupee exchange rate, as well as increase the risk of fluctuations. What exactly is centralized finance, DeFi? DeFi refers to an alternative finance ecosystem in which consumers transfer, trade, borrow, and lend cryptocurrency. Financial products are made available on a public decentralized blockchain network free of traditional financial institutions and regulatory structures. DeFi aims to disintermediate finance by removing the need for trust and middlemen from transactions through the use of computer code. It is a computer-controlled market that executes transactions automatically, user-governed. DeFi platforms are designed to become self-sufficient from their developers and backers over time, eventually being governed by a community of users. What are the advantages of cryptocurrency finance? Financial inclusion. Proponents of cryptocurrency argue that it promotes financial inclusion. Unlike bank, customers can earn usually unusually high returns on their investments, quick and cheap transactions. Crypto finance allows people who have previously been excluded by traditional institutions to conduct transactions quickly, cheaply, and without judgment, low checks and hassles. Because their loans are backed by cryptocurrency, the services generally do not require credit checks, though some to collect consumer identity information for tax reporting and anti-fraud purposes. Users' personal identities are generally not shared on a DeFi protocol because they are judged solely by the value of crypto. What are some of the dangers of DeFi? DeFi eliminates the need for financial regulators to rely on third party to ensure market integrity. In traditional finance, licensed operators such as banks and brokers play quasi-governmental role by collecting and reporting data to the authorities, including information on capital gains to ensure taxes are paid. DeFi programs, on the other hand, are unregulated apps created by coders interested in capital markets. User assets can have been hacked, and not all operators are built with good intentions. The possibility of developers abandoning programs after significant assets have been contributed cannot be denied. Now, let us conclude this topic. New technology asset necessitates a new approach. Novel risks can be addressed without necessarily limiting innovation. For example, rather than requiring DeFi protocols to maintain a bank reserves and collect customer information, requirements such as code audits and risk parameters may be used. Financial fraud control. To combat financial fraud, artificial intelligence and data analysis are being used to monitor suspicious activity and track identity. Monitor suspicious activity. Using artificial intelligence and data analysis to monitor suspicious activity to track it back to its source. Thank you everyone. Let us meet in the next video.